Investors should anticipate more rate hikes to come from the Fed, but at a slower pace, according to the latest meeting. Our next guest says it's important to focus on the bigger picture by investing in companies that will fundamentally perform best if there is a recession. Alger Director of Market Strategy, Brad Neuman, is here with us in studio today. Brad, it's good to see you. We said before the break that the next 18 months, in your view, are going to be dramatically different than the last 18 months. Set the scene for us.
So, the scene starts with a huge change in monetary policy, of course. In 2020 and 2020 and 2021, the Fed printed over $6 trillion, and that was an increase of 40% growth in the money supply. Recently, the money supply has turned negative. That's a dramatic change. It's the first time since 1938 that it's been negative. So you've got this dramatic change in monetary policy, dramatic change in fiscal policy, and that is going to change what was rising inflation expectations and rising real interest rates that compressed valuations. So the highest valuation stocks got hurt the most. That's all going to shift in the next 18 months to falling inflation expectations, stable real rates. So that'll support valuations, but it's going to weigh on earnings. So what was the driver of falling stock prices in the past 18 months, which was valuation compression, is going to shift to kind of earnings headwind. So in the last 18 months, you wanted to be in stocks that had relatively lower valuations that wouldn't get hurt so much by those compressed valuations. And in the next 18 months, you really want to be in companies that can be fundamentally resilient in a difficult economy.
So when you say fundamentally resilient, you're talking maybe cash flow, being able to sell things in the current environment, dealing with margins, predicting for the business uncertainty that we have. Just what are you looking for, and what kinds of companies fall into this basket?
Yep. So part of that is strong balance sheet and high margins, but the biggest thing is companies that are less economically sensitive. And so companies that are gaining market share within the economy, those companies can grow even if the economy is stagnant, whereas companies that are more dependent on economic growth will have a more difficult time. So, you could think of a department store as being more dependent on economic growth versus maybe a leading e-commerce provider that can grow and gain share even in a stagnant economy. So in general, to us, that means that growth stocks, which had done poorly over the past 18 months because of their high valuation, will now do better because of more earnings resilience. So if you look over the past 3 recessions, the decline in earnings for growth stocks has been about a third that of the decline in earnings for value stocks. So I think it starts with growth stocks and companies that can gain market share within the economy.
One of the companies maybe that would fall into this category is NVIDIA, which, as we know, is soaring today after the company came out with numbers. Its numbers declined year over year. Revenue, if you're betting on this as a growth stock, its revenue did decline. But the company is talking up the potential for AI and future sales growth. Is that a company that would fit your criteria that you're talking about?
It is. A lot of times, first of all, in these periods of times when the Fed is tightening, a lot of the media is focused on central bank actions and what's happening in the economic cycle. But what we think is this is the most innovative time in history, and there's a lot of opportunity and acceleration and innovation right now. And one of those areas is artificial intelligence. NVIDIA actually saw growth in some of its key lines of business, such as data centers. And I think the point here is that they are forecasting it to accelerate through the year. So, how many businesses do you know that can grow a line of their business double digits and are gunning for acceleration in 2023? I think that's relatively rare. And in terms of artificial intelligence generally, you had the CEO of Microsoft saying that the age of AI is finally upon us. The NVIDIA last night on its conference call said we're at an inflection point. So we really see that as a great example of a technology that can gain share within the economy.
So if you're talking about here, growth stocks coming back into favor, longer duration plays, seems like an echo of the post-GFC world where we had persistently low interest rates that fostered an environment where a lot of those stocks, those growth stocks, could outperform. Just wondering how that fits, if I have that correct, and then how does that fit in with your recession forecast? Is there a recession on the horizon, and is that what gets the Fed into this lower interest rate, cutting mode that supports and fosters these higher growth stocks?
Well, I don't know if it'll be the same dynamic as it was, in right post GFC, because I don't know that rates will be extremely low. I just think that it'll be the absence of a headwind. So I don't think, if you looked last year, there was a very high correlation between falling price to earnings multiples and rising real interest rates. And all I'm saying is that real interest rates are no longer rising, so that headwind is gone. And so now companies can compound with their earnings growth, and that favors growth companies if they no longer have that valuation headwind. As far as the recession goes, I often tell clients, some of the most expensive words in investing are "it's different this time." And the leading economic index, made up of 10 different indicators, is now down year on year, and that has a 100% track record of predicting a recession. So to me, it seems likely that there will be a recession in the future. And again, that's why I would advocate owning companies that have fundamentals that can prove resilient in such an economy.
So let's talk about another area that you like that is maybe falls into that category, and that's healthcare. And healthcare is an interesting one because, classically, it's seen as somewhat defensive in an economic environment, but there are parts of it that are very growthy, right? That are highly speculative when you're talking about biotech. So when you talk about healthcare, which healthcare are you talking about, or both?
Well, yeah, I think you hit on two important points there, and I think we like both of those aspects. One is that it's idiosyncratic and not necessarily dependent on the economy. If you have a healthcare issue, you're likely to try to resolve that issue irrespective of what's happening with your finances. So we like that piece of it. We also think that there is a lot of innovation there. We think there's a lot of innovation in medical technologies, surgical technologies such as robotic surgeries or minimally invasive surgeries. We also think there's a lot of innovation in genomics and particularly testing within that area. So these are all areas of innovation within healthcare that we think are less dependent on the economy. But as far as biotech goes, biotech was this classic long duration part of the economy where the cash flows are far in the future, and that gets hurt the most when interest rates rise. Again, we think that headwind is subsiding, and so we do think that certain areas of biotech, certain companies will do better now that they no longer have that headwind. So we're investing in kind of the picks and the shovels to biotech, and in certain cases, some biotech companies themselves.
And getting back to AI here, just kind of sticking with the disruption meme, we talked about NVIDIA before. When we think about AI, I could make the argument that Microsoft, Alphabet are really pivoting in a big way towards AI. So you could play that through some of these bigger mega caps, if throw NVIDIA in there, and then you have some of the smaller companies. A lot of people never heard of these. Just wondering where your focus is right now in AI.
I think there's several ways to get exposure to artificial intelligence. One is hardware that you just spoke about, and chips, and so NVIDIA is the poster child for that, but there are other companies like Marvell and semi-cap equipment stocks that could also fit the bill. So there's hardware. Of course, there's the cloud service providers, and you mentioned Microsoft providing artificial intelligence as a service. There's software companies that take advantage of artificial intelligence, like a Pros Holdings or an Intuit. Those are companies that use artificial intelligence in their software product offerings. And related to that is security. Artificial intelligence can both help the bad guys try to hack computer systems, but also will be needed for corporations to fight back. And so companies like CrowdStrike in cybersecurity could benefit from artificial intelligence as well as that arms race intensifies.
Interesting.
We got anything else here? It looks like really appreciate your insights, and thanks for stopping by here with us in studio.